Let's do the numbers. In a nutshell, U.S. and international stocks staged dramatic rebounds in the second quarter, cutting losses in half or better. The lineup: U.S. small companies are now down 13% year-to-date. Overseas companies are down 11% year-to-date, and U.S. large companies are down 3%. The return on bonds increased to positive 6% year-to-date. Interest rates are staying low. In the second quarter, we had roughly 2 months of stay-at-home orders, which repressed certain sectors of the economy. Think retail, think non-essential small businesses. Followed with an initial month of phased-in reopenings where most affected businesses were allowed some measure of operations. U.S. GDP dropped 5% in the first quarter and is estimated to drop 32% in the second, which is ugly as we expected. Projections for the third quarter are hopeful, around 15%. For context, 2019's GDP's growth was 2%. The healthcare sector, however, has made excellent progress on therapeutics and developing vaccines. Congress has injected $2 trillion of stimulus through the CARES Act. Another $1 trillion or more may be added. The Federal Reserve Bank has loaned approximately $3 trillion to businesses, banks, local governments, and other sectors of the economy. We've seen short-term economic indicators bounce back: retail sales, new car sales, mortgage applications, and more. But we've seen COVID-19 hotspots erupt, forcing many states to walk back those reopening steps, dampening the economy again in some areas. What do Neiman Marcus, Brooks Brothers, Dean & DeLuca, JCPenney, and Hertz have in common? They're on the budding list of businesses that are declaring bankruptcy, either to close doors for good or to restructure debt. The upshot: investors have stopped panicking and are evaluating companies again. Which firms benefit? Think technology. Which companies are hurt by this? Think retail, cruises. Investors are parsing all the gradations in between as new data arrives daily. This cold analysis is reflected in our quarterly returns. Note that U.S. small companies are down 13% year-to-date, while U.S. large companies are only down 3%. The stock market has rebounded vigorously from its late March low and trades in the high end of its PE range, price-earnings range. Many say there's a disconnect between the market and Main Street. Some pros agree, some pros do not. What is known is that the market will gyrate during third quarter as good news and bad news ripples over our economy. Liz Ann Saunders, Schwab's chief investment strategist, predicts we'll have rolling ups and downs akin to a W. When does it end? How will the market stabilize? It may be at the confluence of face masks, better public behaviors, and better therapeutics from healthcare institutions. Each needs to get good enough. When? Perhaps fourth quarter, perhaps early next year. Some pros say longer. This market has already shown investors the value of diversified portfolios. A year ago, who would have foreseen the devastation of airlines and cruise ships while package delivery companies soar? Smart investors have harvested some tax losses. Investors are thinking about how they're positioned in small caps. In a market with significant ups and downs, dollar cost averaging into and out of positions is vital, so multiple sell points and buy points achieves that. Smart investors focus on the long term and attend to other financial planning goals: retirement, insurance, estate planning, cash flow, equally well.